Hello, everyone, and welcome to our first quarter housing outlook. Today's focus is on the Midwest. I'm Allie Wolf, the Chief Economist with Zonda and an Ohio native, and I'm pleased to be joined today by Dan Fulton, Zonda's Senior Vice President of Advisory and Northeast and Midwest expert. While not presenting today, I want to acknowledge Justin Williams, our Director of Business Development in the Midwest. Justin's love for the region is partly why we're meeting today. As mentioned, we are with Zonda, the #1 provider of new home construction data solutions. We track the entire building lifecycle, and with our data, we can deliver one-of-a-kind housing insights to builders, building product manufacturers, loan officers, and more. Our database covers key production markets across the country, but as housing trends evolve, so do we. For example, we recently expanded our market coverage to include more metros in Virginia, South Carolina, and Oklahoma. We take our proprietary data and layer in other market health indicators to deliver our clients market snapshots for nearly 70 metros across the country. You can get your free local report today at zondahome.com/market-snapshot. Beyond data, our team provides analysis. And that's why I'm so excited to launch our National Outlook Report later this month. This national report looks at anything and everything related to the economy, housing market, consumers, demographics, policy, and more. We will deliver a custom report once every 4 to 6 weeks to clients, as well as force rankings of the top 100 markets in the country, special research projects, and exclusive events. Be sure to fill out our exit survey following today's presentation to learn more about our national outlook. We also provide more site-specific custom research via our advisory team. Led by Tim Sullivan, our Chief Advisory Officer, our advisory team works on studies like lot and product segmentation, market entrance evaluations, and metro district analysis. Don't forget that we are here to help. If you want to hear more about a local market or a specific subset of the industry, be sure to check out our upcoming events, including a deep dive into Seattle at our Seattle Dealmakers, and a look into the future of master plan communities at Future Place in October. Finally, we not only provide data and analysis, but also solutions. Zonda acquired UTour last December, which provides an on-demand, interactive self-tour experience serving the new residential construction market. With that, it's time to dive into content. And I'm going to start with a 15-minute high-level discussion where I'm going to break my section into 2 parts. I'm going to talk about sales and sales by price tier, and then the top things to watch in the spring selling season. After I'm done, I'll pass it to Dan to focus on the Midwest markets. So where I want to begin my section is by looking at a map that I think a lot of you are probably familiar with by now. This is our Zonda market ranking, our ZMR. What the ZMR does is look at sales across each market relative to themselves over time. We look at seasonality in each market specifically, and using that data, we can make a quantitative ranking. It has nothing to do with our opinion. When we look at the December ZMR, what we find is nationally the market came in as average. In the Midwest, Cincinnati matches that national rank. Columbus, Indianapolis, Chicago, Minneapolis, these markets all were part of that 37% of the top metros in the country that were overperforming. Now, as we look at sales, it's important to look at this high-level take, which markets are doing better or worse, but we also like to see which categories are driving the strength. Traditionally, what we find is there's the highest sales rate per month per community for new home sales at the entry level. There's a larger base of buyers at the entry level market versus high end. We find that as the price point goes up, traditionally the sales rate goes down, just a function of the buyer pool. We're seeing that today. That hasn't changed on a national level. But when I saw this kind of overperformance in the Midwest, I dug into the details of entry level versus move up versus high end. And what was interesting is the overperformance in the Midwest is led largely by the move up and luxury sales categories versus entry level. And so that's why I want to spend the first bit of my presentation looking at these three groups. Now, if you're not in the Midwest, don't worry. We still will show other top markets across the country, but my focus is to track out the 5 Midwest markets that we're showing. So this is looking at the average sales rate. Again, it's per month, per community, looking at 2019 versus current. The black dotted line is the national average. I'm going to drop in the line below the Midwest markets that we're looking at here. And what you'll find from Chicago all the way to Minneapolis, each of these markets underperforming on the entry level, that national point. Now, importantly, this is why we like to compare markets relative to themselves versus relative to national averages, is that when you look at the Midwest and you think about what a normal or good sales rate is, traditionally, if you're looking at somewhere like California, you'd think about 3 to 4 sales per month is good. In the Midwest, we have a different benchmark where maybe 2 sales per month would be considered good. But I think the second important point about the Midwest and where we're seeing that sales rate today is that I think there is a little bit of pain that's occurring in that entry level, just a little bit more of a struggle than maybe in the past because of what's happened to pricing. So you can track out here, I'm showing you the price appreciation for entry level by market. The lines are above Indianapolis, Chicago, and Minneapolis. The reason I pull this out is if you look at what the entry level pricing was in Indianapolis before the pandemic, it was a $200,000 price point, which is pretty all inclusive. That's you don't need too high of an income to be able to afford that price point. You can see it ranged from 200 to 300,000. Now what we're looking at is that entry level is between 300 and 400,000, which I think is why in some of these markets you see that the overall sales rate's not completely outperforming where it was back in 2019. But let's move to the move up market. And the way that you should think about this is entry level is the bottom third, move up is the middle third, and the high end is that top third. Here, you see a little bit of a different story where you actually find a cluster, Indianapolis, Columbus, the national average, and Chicago all right around each other. And I think very importantly, track out how the purple bar is a lot higher than the blue bar in those markets. Cincinnati, Minneapolis, you're seeing actually a little bit of an underperformance compared to 2019 when you get to the move up market. But when you look at move up, I wanted to again provide that context. We're talking 20 to 30% home price appreciation since the pandemic, where move up pricing traditionally was between 300 and 400,000. Now the new move up is between that 400 and 500,000. Now let's wrap things up here by looking at the high end part of the market. Again, dotted line is going to be your national average. If you're looking at the 2 lines I just dropped in, this is Indianapolis and Chicago. To me, not only are these markets outperforming the national average, but look at how wide that gap is between the purple and the blue. Same thing is true Columbus, Cincinnati, and Minneapolis. As you look at these markets, yes, a little bit of an underperformance for the national number, but again, that's not really that ideal benchmark. It's the idea that these markets are seeing more strength relative to themselves. Now, I attribute this to 2 main things. Part of this is just the idea of who are the buyers that are still active today. If you follow our research, you know that we've talked a lot about how it's, in general, older buyers are more active today. Those that have wealth are more active today. Those that don't have as much sensitivity to interest rates. So I think this is part of the reason that we're seeing the outperformance compared to 2019. Importantly, not just in the Midwest, but also you can track in many top markets across the country. But I think the other big thing is what we're seeing with that idea of relative affordability. Now, the Midwest states are not among the top 10 for the most migration, but we do know that since the pandemic, people that had roots to the Midwest, maybe grew up in the Midwest, moved somewhere else, or had family members that live in the Midwest, considered moving back, and many did. And so this is showing you the price appreciation for that high-end part of the market and what high-end looks like. So you can see in Minneapolis, we're now looking at that top third at 700,000, Indianapolis at 500,000, Chicago at 6. This is the high-end part of some of these markets in the Midwest. I live in California now. That's the entry level price point for many markets in California and along the East and West coasts. And I think that relative value is another reason why we have seen some of that overperformance in that upper third in the markets for the Midwest. Now, switching gears entirely, I wanted to go through, to me, it was really interesting to see how those dynamics have changed over time. But I also want to talk about the spring selling season. We know that the Super Bowl is that unofficial start of the spring selling season. And just this week, we put out an article on Builder Online of the top 3 things to watch. And so as I wrap up my segment of today's presentation, I want to go through those 3 things quickly. We're going to look at listings. We'll talk about housing starts, and then I'll finish with a discussion on Fed policy, in particular, how Fed policy plays into our industry. So many of you know we love to show this graph. This is our really good way to look high level, what is happening with resale inventory. It's showing you this data nationally by month, by year. The red, if you spot the red right around January to February, shows where we are so far in 2024. So the good news is we have seen a little bit more inventory to start the year, the highest data for January that we've seen going back to 2020. The bad news is active listings still down 40% compared to 2019. And so this is showing you the active listings count by different markets. Again, if you look for some of the Midwest markets, you're finding this drop of down between 20 and 60% compared to pre-pandemic. We had our housing market update webinar with Tim Sullivan a couple weeks ago, where I pulled this data. Chris at Inman was able to give it to us, which is then saying, all right, if we understand the backdrop is not having huge mobility on the resale side, what are the factors that could drive it? And are there any indications that lead us to believe it could go up? So what Inman does on a regular basis is they talk to realtors and they ask them about their listings pipeline. What do you think will happen 12 months from now? Now, I think this is valuable because realtors are the boots on the ground. They're talking to people. They're looking at their pipeline. Why might someone be willing and able to sell? Right now, 50% of the realtors said that they do anticipate to see more listings over the next 12 months. And they didn't say this specifically, but I think it's a combination of people that are sick of putting their life on hold, people that are having these life events, whether it's getting married, whether it's retiring, and the ability for some people to tap their equity, especially if interest rates come down a little bit, that can help create some more mobility. Another big thing, though, is that we know people have said we would be willing to sell even with interest rates higher if there was something compelling on the market. And so if we see more listings, it could create a bit more of a virtuous cycle of mobility, but it may actually need to come from more construction on the new home side first. So like I said, housing starts the second big thing that we need to watch for the spring selling season. And I'll say the 3 that I picked, it was on purpose. The listings, housing starts, and Fed policy, I think are 3 things that could make or break the housing market in 2024. But as we look at number 2, before I go into housing starts forecasts, I wanted to show why this is so important. This is showing you the national new home community count anywhere where there are 5 or more units for sale. I also want to pull up this data for Indianapolis, Minneapolis, and Chicago. The range that we see is down 3% compared to 2019 for community count to down 44% compared to 2019. Now, specifically, I will say down 44% is in Chicago. Jana runs our research division here at Zonda. I called Jana right away when I saw this chart and said, this looks wrong for Chicago. And we vetted the data, and it does actually appear to be right. But this idea that total community count it fell in 2021, but has held at this low level, where you can see on the chart, really have held here for the past couple of years, is why we are seeing some of this enthusiasm to build. In fact, as we talk to builders about starting more homes, sometimes the comment is just, we want to backfill our community count. And what that's doing is still supporting this focus on land acquisition. This is from Zonda's Builder Survey, where we asked builders how they are thinking about land ac. Nationally, 53% are full steam ahead, 42% cautiously moving forward. When we look in the Midwest, basically identically in line with what we're seeing nationally. There's a little bit of caution, but still a slight majority of builders in the Midwest full steam ahead on land acquisition. So that then takes us to this idea of what might happen with housing starts. Many of you know we like to show what builders have told us before we show you our own forecasts. And what we capture is that about 75% of builders nationwide anticipate starting more homes nationally this year than last year. For the Midwest, it's a 40-40-20. So we have about 40% that expect housing start to be about the same, 40% that expect housing starts to be up, and 20% that expect housing starts to be down just modestly. For us, as we roll all of this together, we're looking at what is expected to happen with resale inventory, what is expected to happen in the overall economy, what do we have available from land and lot supply, which Dan's going to talk a lot more about later related to the Midwest. We've come to our forecast of about 2% growth for single family housing starts. And I will say, the more I think about this year, the more I think we may be underselling it. I think our range is probably, maybe we'll bump our forecast up to closer to 5% for an increase in single family housing starts this year. Multifamily, we're still calling for a drop of about 25%. Many of you know this is partly because there's a fear of some markets having a very short-term oversupply of rental product, but also this side of the market having more pronounced capital constraints. Now let's go to our third and final point here, which is Fed policy. And what I'll tell you is the way that I'm going to show you this trend is exactly what we're showing in our Zonda National Outlook, our first report that comes out later this month. What we did in this report, thanks to Todd Tamilak, our building product experts, is we had 3 statements that I'm going to show here. We actually have about 15 statements on the economy and the housing market, where we make a statement and then we assign a probability to that statement. And then we say, okay, what could make us right? What could make us wrong? Here, I'm just going to show you the statements and the probabilities. So when we look at Fed policy, statement 1 is that the Fed will cut short-term rates at least twice this year. We put that probability at 75%. And some of you have heard me say this before, it's not going out on the limb. The Fed has told us that they anticipate their next move is going to be cutting rates. We don't believe, though, that's March. We really never believed that the first cut was coming in March. We think it probably happens second to third quarter of this year. Related, another statement is the full year average of the 30-year mortgage rate will be below the prior 2023 full year average of 6.81%. Our probability here is 74%, not a typo, and not one of us just choosing to do 74%. It's an average of multiple people's estimate for this, multiple experts within Zonda that got us to 74%. But again, if you follow our work, one thing that we've said consistently is one piece of economic data better than expected or worse than expected can cause some very quick and kind of surprising changes to mortgage rates. And I think no example is better than that than yesterday, where we got a little bit better of the inflation read, where you saw the 10-year Treasury yesterday get to the highest level we've seen all year, pushing interest rates back up into the 7s. So that is something that we're continuing to watch, that any kind of surprise will shift how investors place their money and can play into the 10-year Treasury, which of course, by extension, plays into mortgage rates as well. The third point here that we've talked a lot about in the past is the idea of why would mortgage rates go down? Well, we think part of it is the Fed cutting rates, and we think part of it is the spread between the 10-year Treasury yield and the 30-year fixed rate mortgage ultimately narrowing this year. And we put that probability at 72%. So as we look at Fed policy, assuming our assumptions are correct, we should have, from a policy point of view, policy working in favor of the housing market as we go later into 2024 versus working against the housing market that we've seen since 2022. With that, I'd like to introduce Dan Fulton, Zonda's Senior Vice President of Advisory and Midwest and Northeast expert. If you don't know Dan, you are missing out. Dan has over 30 years of experience in the real estate industry, ranging from land acquisition to market development and advisory services. Personally, I've known Dan since I started in the industry, and I have relied on his insights over the years. So I'm excited for you to hear from him as he talks through the Midwest markets. Dan, I'm passing it to you.
Well, thank you, Allie, and I appreciate the kind words. And it's always been a pleasure to work with you and hear your insights on the national economy. Let me go ahead and dig into the Midwest markets that we'll cover today. We're going to be looking at Chicago, Minneapolis, which we'll call the Twin Cities for this conversation, and Indianapolis. And these are three very dynamic markets with strong housing industries. And we'll be digging into the supply, demand, and the overall housing health of the three markets. Let's start with Chicago. Chicago is just a dynamic market with a big history from the Great Recession that we'll discuss a little bit later. But it has a really strong economy based in the financial sector, with it's home to several financial exchanges, the Chicago Mercantile Exchange, the Board of Options Exchange. And it's also got a strong food industry and agribusiness industry that it relies on. It's home to several large corporations, Fortune 500 corporations, and the infrastructure is strong. So it has all the makings of a very strong market, and the demand drivers of this market are strong and active today. On the screen, you'll see some of the companies in Chicago that drive that market and drive that economic growth. Moving over to Indianapolis, I've done a lot of work in Indianapolis lately, and it never ceases. I've never ceased to be amazed with the level of activity and the price points that are being hit in the northern part, the Carmel submarket of Indianapolis, homes in the $1 million range. It's driven by healthcare, pharmaceuticals, agribusiness, very similar to Chicago and Minneapolis for that matter. It's got a strong infrastructure. It's an airport that's very easy to get in and out of, good public transit and other recreational amenities. And it's got a strong culture surrounding the college and professional sports teams in the marketplace. So some of the companies you'll recognize, almost all the companies here, but I'll point out, the agribusiness companies, the Corteva and Telenair. It's a pretty interesting company that uses drones to evaluate the health of farmland. Lilly and Anthem and Roche, very much in the healthcare business. Lilly is just skyrocketing these days with its weight loss drugs and expanding throughout the Indianapolis area. And Indianapolis has strong distribution networks given its location, served by multiple interstates, and you can get really throughout the eastern part of the country pretty quickly. So you have Amazon and FedEx, and then you have Salesforce in there as well, which is a very strong employer in downtown Indianapolis. So moving forward to Minneapolis, I'll be a little bit quicker on this one, but you have a strong healthcare presence in Minneapolis. Mayo Clinic is a major employer along with Medtronic, but you also have food, Cargill, General Mills, and you have other Fortune 500 headquarters. So it's including Target and 3M. It's a very strong economy in downtown Minneapolis, and it's got a very strong housing market as a result. So let's take a look at the economic growth, the employment growth by metro area, and within this slide you see the year-over-year employment growth for each metro, and I'm including several mid-Atlantic and Northeast markets just for comparison. But if you look at this slide, you see Indianapolis is enjoying the fastest employment growth in 2023, roughly 2.8% compared to Chicago and Minneapolis, which were just around 1.5 to 1.7% growth. So Indianapolis is enjoying much stronger employment growth and stronger than all markets on the screen other than Philadelphia. Unemployment is also strong in Indianapolis and Minneapolis, but somewhat high in Chicago. But it's to be expected in a very mature industry that with a lot of blue collar employment as well. But you can see Indianapolis and Minneapolis are roughly at full employment, along with Baltimore and Washington. So very, very strong economies in those markets. But it's this slide that's I find to be most interesting of these three. You have what we're showing you are the the percentage of all jobs that are high wage jobs in these markets. And for context, and we're also showing you the growth, the annual growth in the number of high wage jobs. So this shows you, number one, that Chicago has 26% of its jobs are in high wage sectors. That includes professional and business services, finance, information. But it's also showing you that you have a drop in the number of jobs annually. So that's putting pressure on the new home industry. So that may be causing some slowdown in the new home industry over the last year. Indianapolis has a relatively small number or percentage of high wage jobs, but it's showing significant growth in that sector, almost 2% annually growth in that high wage sector. Minneapolis, relatively low percentage of high wage jobs. And you're seeing a decline in the number of high wage jobs as well over the last year. So these high wage jobs, why I focus on this is that these are the folks that typically are purchasing new homes. You know, that's a blanket statement going across the country, but because in the more affordable markets, as Ali mentioned earlier, some are more all-inclusive. You know, the entry level could purchase, have a relatively low income to purchase a new home. But for the most part, it's the high wage jobs and the households that have those that are purchasing new homes. In terms of home value appreciation, what we're showing you here is from the FHFA Home Price Index, and we're showing you the appreciation rate from 2014 to 2023 to show you that, okay, you know, the Midwest markets and the Mid-Atlantic really have been acting similarly all throughout these years, in that with 2 to call it 5% appreciation, maybe reaching 6% appreciation. Up until 2020, all markets shot up in the period after COVID and have subsided as rates rose, et cetera. But today, the Indianapolis, Chicago, and Minneapolis markets are roughly in that 3.5 to 6% appreciation rate throughout the upper Midwest, similar to the other markets that are shown here. Now, we did look at quarter over quarter appreciation, and we found that the appreciation rate did go negative in 23, but it recovered quickly, and it's now positive. So we expect positive home value appreciation, probably along the same lines what you see today for 24. So let's look at the resale market conditions in these markets. I'll go a little bit more quickly on these slides. So days on market, you know, it's an indicator of inventory, but also demand in the marketplace. And if you look at this slide, you can see that the market from this time last year, so year over year, has the number of days on market remains lower, and that I attribute to tight supply because demand has dropped somewhat due to the higher interest rates. But because you're seeing a tighter supply, tighter level of inventory on the marketplace, you are seeing a tighter, fewer days on market. When you look at the average sale price to list price ratio, this tells me that the market has, listings have gotten to a level where they're selling just below list price. So back in the uh, 22, when the frenzy was going strong, you saw listings in the Minneapolis. If you take a look at early 22, sales were about 4% above list prices. Today, it's below list price. So that tells me that number one, listing home values are as being listed are realistic, and that there is a little bit more competition on the market than there has been in the past, and that slightly less demand. So there's the seller's market is not necessarily gone, but it's softened a little bit. Median sales prices have gone up year over year in Chicago and the Twin Cities. Now, Indy remains flat with much less volatility. You can see the during 23 didn't reach the highs and have the peaks that the other markets had, but it did settle down to relatively the same point as it was last year. Months of supply increased from earlier in 23, but it still remains below this on a year-over-year basis, this time last year, as shown here. But if you look at the supply level, the months of supply earlier this year in 23, you're seeing a significant increase in the inventory levels on a month's measuring by months of supply. It's our opinion, Zonda's opinion, that a 4-month supply of inventory in either market, any of these markets, is healthy for the state of the housing industry, giving people plenty to choose from and creating more of a dynamic sale and buyer marketplace. So let's take a look at what has sold well in these markets. What I'm going to show you here are the top selling communities, both attached and detached, for each of these metro areas. So in Chicago, Chelsea Manor by MI Homes has taken the top spot with 81 sales over the last 12 months. These are townhomes, good looking townhomes, a variety of different types of townhomes, selling from the 330s. And this is in a market area that's on the perimeter of the metro area outside of Naperville in Kane County. So Naperville is a very popular submarket, and this allows people to be close enough to that submarket to feel the draw. Meadows of West Bay by Lennar, also in the Chicago submarket. Now, this is in Wonder Lake, Illinois, and that's in McHenry County, somewhat near the Wisconsin border. You have a 1-hour commute both to Milwaukee and Chicago. So if you have a household who with spouses that live and work in, or who work in either market, it's a very popular place to live. Now, here you have also affordability, single family detached homes from the 330s. They've managed to sell over 100 homes over the last 12 months. So in the Twin Cities, Bridlewood Falls by Lennar, you're going to see Lennar in several of these profiles. Woodbury, Minnesota is in Washington County. You have single family homes from the low fives. And the Woodbury submarket is pretty close to the St. Paul portion of the metro area. You can see in the picture in the close distance, and then in the far distance, you can see Minneapolis. Over the last 12 months, you've had 68 sales in this market. Very attractive small community here. And then Watermark, Colonial Patriot Townhomes by Lennar. You're in Lino Lakes, Anoka County, Minnesota. So you have single family attached, so townhomes, more like a villa from the 350s. 58 sales over the last 12 months. And this is in that first tier suburb north of Minneapolis. So very attractive location. popular with empty nesters, active adults, etc. And then in Indianapolis, Westgate Venture by Lennar. This is in that very affluent county north of Carmel. It's in Hamilton County, and just very attractive. A lot of business up here, a lot of work helping out our developer clients. Now, here you have single family detached homes from the 340s. And over the last 12 months, you've seen over 100 sales by Lennar. And their townhomes are doing well as well. You know, over the last 12 months, they've had 82 townhome sales in the same community from the 330s. So again, you attribute a lot of this to that activity in that part of Hamilton County, just north of the city of Indianapolis. The new home market conditions. Let's take a look at the active projects. Ali brought up a slide earlier that showed the number of active projects. It's the same data, just shown differently. Here in the Chicago metro area, you can see that today we have 266 active new home projects in the market. That's a 44% drop from the 2018 peak. The maximum of 472 projects in 2018. If you look at Indianapolis, 225 projects. Let me go back to Chicago real quick. One thing I wanted to point out is that you can see the orange portion of these columns is the attached, the blue or detached. You can see the share of detached homes is getting greater where attached product and communities are shrinking. So that's an interesting dynamic for a mature market area where you typically see attached higher density homes gaining more share. If you look at Indianapolis, you've only seen a 26% drop from the 2018 peaks of 303 communities. Today, Indianapolis has 225 communities with a very small share of attached units. Most communities in Indianapolis are single family detached by far. But take a look at Minneapolis. 455 active new home communities, very little change from the peak of 2020, only 4% below that peak. And you have an increasing share of attached units as attached becomes more popular in the Twin Cities metro. Builder competition. You know, there's quite a bit of competition in all of these markets. It appears to be more fragmented in Chicago and the Twin Cities with 72% of builders of the top 10 builders capturing 71 to 72% of all market share. Whereas in Indianapolis, where you have dominant builders capturing most of the sales, the top 10 builders in Indianapolis capture 87% market share. So who are these builders? There's 4 dominant builders that in the upper Midwest markets and the markets we're talking about today. Lennar by far is #1, followed by D.R. Horton, Pulte, and MI Homes. Lennar, if you take a look at Chicago, has 19% market share, which gives it the #1 slot. In Indianapolis, the #1 slot gets you 32% market share. 1 out of 3 homes in Indianapolis is built by Lennar, and 1 out of 4 homes in Minneapolis is built by Lennar. So these other builders have a solid program selling over 400 or 500 units a month, or I'm sorry, a year. But Lennar takes the lead in all 3 markets by far. So looking at the average sales rate per project, as Ali mentioned earlier, we looked at some of this data earlier. The Midwest markets typically don't have the strong 3, 4, 5 sale a month programs that you see in other markets. 2 sales, 3 sales a month is fine, and it's appropriate for this marketplace. The lead of these 3 is Indianapolis, where it's with just about 2 sales a month, and that has dropped later last year, earlier this year. from about 3. It dropped from 3 in middle of 23 to 2. If you look at Chicago, Chicago has reduced the gap between that market and Indianapolis, selling just over 1.5 sales a month, slightly below Indianapolis and slightly below the national average. But it has increased its sales pace from compared to the Twin Cities, Minneapolis, which is right around that 1 sale a month rate, and it's been there for quite a while. Home builders have been steadily increasing prices there, and then we're looking at base prices here. And that is going to help with the margin squeeze. We've had quite a bit of price and cost increase over the last few years. So builders have been able to increase their base prices. Today, Chicago's at $620 average base price, and this is a base price of what's available, or I'm sorry, of the units that have sold. The Minneapolis market's $565 average base price, and the Indianapolis falls quite a bit lower than that at $428,000 for an average base price. So this indicates also not only where product is selling, closer in versus farther out, but also the type of product selling. If a market has a lower number of detached, higher number of attached housing units, you'll see a lower base price, where a market with a higher percentage of detached homes will have a higher base price. So in terms of a percentage of base price, Chicago has had, all markets have seen strong base price increases over the last few years. Chicago has seen quite a few, ranging from 14% in 23, 20% in back in 2019 before the pandemic. You did see a slowdown in 22 with a 7% increase, but it's been strong increases overall. You're looking at 24 year-to-date increase, so we're looking at a 3% increase over the average for 23 already in 2024. But you also see strong base price increases in Minneapolis and Indianapolis as well. So where are these sales happening? What we're looking at is the change in sales by base price range. So this is year over year. This is annual change of sales for 23. So ending in the fourth quarter of 23. Chicago, looking at that market, you've seen a decline in the top end, a very minor decline, but you've seen strong increase in that $400,000 to $750,000 range. A modest increase in the $3 to $400,000 range, and a decline in the lower price range. Twin Cities have seen a significant increase in sales from $250,000 all the way up to $750,000 plus. So all across the board, you've seen a strong increase in sales in every price range. And then Indianapolis, very strong showing in nearly all price segments, strongest in that $350 to $750 range, but also good activity in that $250 to $300 range. Slight decline in the threes and over $750 over the last 12 months. So overall, strong improvement in virtually all price ranges. So let's take a look at inventory, and something we look at as the market dynamics change, and we have changing demand factors, changing supply. So we keep a close eye on supply, and we look at months of supply for the finished and vacant homes, but also land. And we'll take a look at land later. But as far as finished vacant homes, that's Zonda speak. It's also called quick move-in homes. Also called spec homes. So, but as far as in Zonda speak, finished vacant homes, you're looking at a relatively strong supply levels in all three markets. Chicago has the greatest supply of finished vacant homes, but it's consistent with where it's been over the last 10 years. Today, you're just under 3.5 months of supply. And it's been rising slightly as builders are using the quick move in homes to address the lack of inventory in the resale market. You're seeing more and more use of quick move in inventory to address that market and capture market share from the resale market. You can see in the Twin Cities and Minneapolis, you can see that significant increase in finished vacant months of supply, and in Indianapolis as well, although it's tailed off a little bit, but it's significantly higher than it was in 21 and 20. Let's shift the conversation to land. So we saw the land index earlier. Here we're looking at the market and the Zonda land supply index segmented by the categories significantly undersupplied, slightly undersupplied, or adequate or oversupplied. And here we're seeing that Chicago and Minneapolis are appropriately or adequately supplied, somewhat oversupplied in Chicago's standpoint for land. And with Minneapolis being significantly undersupplied, but it's on the high side of that. I think there's strong enough developer network within Indianapolis to handle this undersupply. And looking at vacant developed lots, months of supply, a vacant developed lot is a finished lot. So you can see over the last 10 years, the number of and the months of supply of VDLs has declined significantly from in Chicago land, 90 months of supply in 2014 to 40 months of supply today to rebound slightly. We'll call that a healthy market given where they came from. And I have more information on that. Pretty interesting analysis I did. And then you have in the Twin Cities and Indianapolis, they track very similarly, very strong. They dipped down to 10 months of supply, but rebounded back into that 20 to 30 months of supply in 23. So we'd call this a healthy market in terms of the number and the quantity of vacant developed lots available. Where has that change occurred in terms of price point? That we've seen decline in the number of vacant developed lots, but that's what we've seen in Chicago is that you've seen an increase in VDLs in that 500 to 750 range, and then a decline in virtually all lower price ranges. In the Twin Cities, you've seen again an increase in that 500 to 750 range. This is cut off, goes up to over 700 lots. But in all other price ranges remain relatively the same, with a slight tick up in the 400s and 300s. But take a look at Indianapolis. You see significant gains in the number of vacant developed lots, wide-reaching, a variety of different developments coming on board. So you have strong supply in all price ranges from $250,000 plus in Indianapolis. So taking a look at a deeper dive into the Chicago lot supply situation, we're looking at the light blue columns is vacant developed lot inventory. So these are the number of vacant developed lots in the market. The dark purple are the number of housing starts in the market. And just understand that a start eats up a vacant developed lot. And so the difference is in the markers here, you see here, the yellow markers are the months of supply. So this is our continuing gauge of inventory levels in for your lot supply. So again, we talked about Chicago earlier, 50 months of supply of vacant developed lots. How on earth did it get to 50 months of supply? But you have to go back to where it came from and take a look at the peak of the market back in 2006, where you had Chicago had 47,000 starts in 2006, shrinking to just in the 6,000 range today. 66,000 VDLs in 2008, 227 months of supply after the market tanked. So we've been working our way through this vacant developed lot inventory over the last 20 years. And that has really affected the market. You can see this analysis, this analysis takes a look at the by zip code, the number of vacant developed lots in communities with no annual starts, meaning there's lots sitting on the ground, but nobody's working on them. And that's, to me, is an opportunity for an investor or developer. And I think that's one of the reasons why you have such a fragmented industry, because you have a lot of supply to work through. But you can see in the darker color dots, these are all zip codes. You have 200 or more VDLs in dormant communities in these zip codes. So it's pretty interesting to look at, but I think we're going in the right direction, eating through that VDL inventory in Chicago. Indianapolis and Minneapolis aren't nearly as exciting as Chicago. So you have the VDLs, slight oversupply back after the Great Recession, worked our way through that, really strong starts, activity and momentum leading up into through the pandemic and afterwards. Slight decline in the number of starts, which has caused and thankfully resulted in the months of supply becoming more and more healthy, reaching up around that 20-month range. So overall, as I mentioned earlier, I think India has a pretty strong and healthy lot supply situation. And so does Minneapolis. Minneapolis, came back after the Great Recession, came from about 45 months of supply, dropped down to 10 months or 10 to 12 months here in 2020, but has rebounded as starts slowed and the deliveries increased to roughly 25 to 30 months of supply. We think this is a healthy supply level for the Minneapolis market. So let's take a look at the outlook. I'm running a little bit ahead of schedule, moving forward and relying largely on quite a bit on what Ali has mentioned earlier. I think the housing markets in these metro areas will strengthen over the coming years as consumers regain confidence, reducing interest rates. You're seeing strong activity in the stock market. All three markets have posted quarter-over-quarter increases in starts activity, and that tells me that people are re-engaging, getting back into the housing market. The new home capture ratio, the percentage of home sales that go to the new home industry, will increase as the resale inventory remains tight. As until rates drop, and for a period of time, we feel that the lock-in effect will stay in effect, and that people will stay put, and that the supply will remain tight. I think builders have a real opportunity here to capture quite a bit of that overall home sale market share. And because of that tight inventory levels, I think builders will enjoy pricing power despite lower EP ratios. If we think pricing job growth may remain, moderate, not skyrocketing, but moderate levels over the next year. Permits are probably going to increase as the people come back into the housing market. Because of that, I think with the lower EP, it will cause a lower employment to permit ratio. I think builders will enjoy pricing power despite that ratio dropping. Typically, we're looking at 1.2 as equilibrium, and as for an EP ratio, I think a 1.2 will still remain a good number to keep an eye on. But typically, builders lose purchasing power if it goes below that, and gain when it goes above that. I think you'll still see pricing power despite lower EP ratios. So work from home trends will continue to open up demand for smaller markets, and that speaks well for Indianapolis, even Minneapolis, and some of the outer markets of those metro areas. And then home value appreciation will remain moderate as rates remain high. Once rates start to subside, I think you'll see some movement on home value appreciation, but I'm looking at rates in that 3 to maybe 5% range. So looking at starts and our starts forecast for the three metropolitan areas, From 2000 to 23 to 24, Chicago, I expect a 2% gain in starts. Indianapolis, 5%. Minneapolis, I'm keeping at 2% given the level of competition in that marketplace. And then in 25, I'm looking at a stronger market, roughly 5% appreciation moving forward. So that, folks, is my presentation. I want to thank you all for joining me here today, and Allie, and we'd love it if you gave your input and your feedback on our presentation. So this is your QR code. Please click on this and answer a survey and get more information about what's going on at Zonda. Thank you, folks.